Welcome to Raw and Real Real Estate with your host, Marisol Ortiz. Here, we cut through the noise and have honest conversations about the housing market. Each episode brings you real insights, stories, and perspectives from inside the industry so you can better understand what's really happening in real estate today. Welcome back to Raw and Real Real Estate. Today we are answering the questions every borrower should ask. How much interest rates really matter, whether 20% down actually drops down your payment, and when refinancing makes sense, including any fees to watch out for. By the end, you'll walk away with tips that can save you money and stress in your home buying journey. And if you get value from this episode, make sure to give it a thumbs up and subscribe so you don't miss out on future episodes. To break this all down, I have invited Cesar today. Cesar, can you please introduce yourself to our listeners?
Yes, ma'am. Thank you so much for having me on, Marisol. My name is Cesar Garcia. I am a mortgage loan originator. I've been in the industry a little bit over 15, maybe 17 years if we're rounding up. And I'm very excited and pleased that you had me on.
Thank you for your introduction today. I really want to dive into interest rates. They're on the headlines so much. What do borrowers really need to know about them? And honestly, should they really be worried?
So that's kind of a loaded question, but my biggest thing is always asking borrowers what their end goal is when they purchase their home. If this is a home that we're going to have for a long period of time, if this is something that we're going to have for 30 years and we plan on paying it off as so, um, whether you have a 3% rate or a 9% rate, it's very important to keep in mind that interest is only as effective as your payments. Meaning, if you can make additional payments once a year, a couple of extra payments here and there, like these are 30-year loans, but we never want you to pay them off as a 30-year loan. Otherwise, the interest is going to eat you alive. Again, whether it's a 3% rate or a 9% rate, it's really up to you as a consumer to understand what your goal is and understand how rates work so that you can kind of not manipulate it but control it by making additional payments, maybe refinancing somewhere along the term and saving some money on the rate. I don't know if that answers your question as directly as you want it to be.
Yes, it does. I think what you're just trying to say is that we really just need to make sure when we're buying a home, we need to make sure that we analyze what the end goal is. If we end up doing the minimum monthly payment on our mortgage, I know you provide amortization schedules. How much money do we end up paying in interest in the long run after you see?
So on most 30-year mortgages, on a minimum, I mean, we're talking about at least twice over. And that's a bare minimum. I mean, some cases we're, going 130, 135% over. So that's why it's really important to understand rates when consumers come in and talk to me about, well, rates are too high. My reply is always like, well, there's always a way to mitigate that by making additional payments. If you're really concerned about rates, then let's maybe finance this home for 15 or 20 years. And then the real concern becomes, oh no, it's because I want a low payment. So to me, that tells me, well, you're not concerned about rate and its long term effects. You're more concerned about a low monthly payment. And if that's your concern, then let me teach you and show you additional ways to get there that don't necessarily involve rate. So whenever someone comes to me and says, I have a concern about interest rates, my answer is always like, was your concern about the high interest rate and what you're going to pay over the next 30 years? Or is your concern about your minimum monthly mortgage payment? And if the answer is like, well, it's more about the mortgage payment, then I'm like, then the rate is a component of that, but the amount you're financing, how much you're giving down is really what we're going to have a conversation about.
Okay, so you really have to take your eyes off the interest rate at that point and analyze other things that are impacting your monthly payment.
Absolutely. And I mean, I'll deviate a little bit and I'll tell you this, when I meet with most of my customers in person and I go over what are the 10 most important things for your home. Once you're pre-approved, you're going to go out and look for a home. I always give them my 2 cents because I've sold homes before. So I always tell them, what are the top 10 most important things when you're out here looking for a home? And they always go, well, I want it to be on this side of town with a nice backyard and the sun hits it here. And they'll list 10 or 15 things. And I'm like, at no point did you talk about rate or payment. So the whole conversation we had about you wanting a low monthly mortgage payment goes out the window the second you start looking at homes. So it's very important for me when I meet with my customers to identify once you set your threshold for a monthly payment, then the rate becomes a mute point. And because your focus is, I want this home, this location, and then the rate and the payment kind of go out the window pretty fast.
That is true. And personally, because I am on the end, I am the person that gets to take the borrower out, and the borrower is the buyer looking at the home that where the sun hits it the way that you said. I always tell my clients, think of a monthly payment you'd be comfortable with. And before, when we just started, I think $1,000 was the monthly payment that most people gave us. That is no longer an
Good old days.
attainable, really,
Yeah.
monthly payment. But anyway, people would throw out their number, and I would say, great, ask your lender, what price home do I need to be looking at so that we can hit that targeted monthly payment. And we would start looking there, and so people have their desired monthly payment, and then they have their max,
Yeah.
right?
Yeah.
But they desire this monthly payment, but in reality, they qualify for this max. Of course, we never advise them go to your max. So we start here. And honestly, when we start seeing houses, we end up somewhere in between
If we get lucky.
if we get lucky. But it very quickly we begin to realize, interest rate, payment
Yeah.
starts going out the window once we
Very
can
fast.
see what it is that we can acquire at the budget that we have in mind. So
Yeah.
thanks for sharing that. I want to talk a little bit about hidden costs. A lot of first time buyers get caught off guard by costs they didn't expect. What are some of the most common hidden costs you see, and how do you help your borrowers prepare for that?
So I think one of the conversations I have, and I have tons of these conversations, is mortgage loans are risk-based driven, meaning the risk is assessed at different tiers. Whether your down payment, how much you're coming in with, if it's coming out of your own pocket, or are we using an assistance program? Are we using an FHA loan or a conventional loan? How high is your debt to income ratio? And those are all things that we touch base on. And then we fall back on credit score. So as we're pricing out your mortgage loans, if your loan is considered to be a little bit higher risk, meaning you're not coming in with your own down payment, we're maxing out your approval, so to speak, then rates might tend to be higher. And when you talk about hidden fees, I mean, I think most lenders tend to be pretty upfront about the cost of purchasing a home. And we have these conversations now, especially today, when we're running into sellers that don't help pay every single closing cost like we did in the old days. But we tend to be pretty upfront with stuff like that. But where we can help you guys mitigate some fees, or some fees that might be built into like things like the interest rate and the loan type we're getting, are just the basic decision of, well, I don't want to come in with a down payment. Automatically, most of these down payment assistance loans come with discount points and additional processing fees and underwriting fees, because now you're adding a completely separate entity, whether it's a state provided program, a first time home buyer program, whether you're a first responder. So there's fees that just start getting tacked on up front. And for me, it's always like, if you can come in with your own down payment, that's going to help you in plethora of ways, from the interest rate to saving money on fees. So again, just to circle back and answer the question directly, is the hidden fees are mostly going to be based on the loan type we're getting and all of the underlying factors to your loan. Whether it's you're coming with a down payment, where your credit score's at, are we maxing out your approval, how many people are on the loan, and all those things might have additional fees depending on how we move forward.
Thank you. It's definitely a case by case scenario. Nothing applies the same way to one borrower than to the next. So they really need to sit down and discuss with their lenders what exactly is are the fees that they're looking at. So let's compare 20% down versus 3.5%. Most people assume that putting down 20% will actually drop the monthly payment. But would you agree with that?
So giving 20% down absolutely gives you a lower monthly payment, yes. But I always like to recommend my buyers not to, just throw a bunch of money at it and see what happens. So to put you in perspective, for every $1,000 additional you give on top of your down payment, your monthly mortgage payment is only going to go down anywhere between $6 to $7. So if you put that at scale, for every $10,000 you give down, your payment's going to go down between $65 and $70 a month. So when someone comes into my office and says, I want to give 20% down, I've been saving my whole life to purchase this home and I want a low monthly payment, I start with, well, what's that payment? And then we work backwards, because sometimes you can get there by, instead of doing 20% down, maybe you do 10% down, pay off your mortgage insurance and buy down the rate, invest 15 to 17% and save some money. Um, Again, to answer your question directly, 20% down is absolutely going to give you a lower payment versus a 3.5% down. But I don't think it's always a component of just pump more money into it to get a lower payment. It's also being strategic about how you invest the money.
Thank you for that. You have worked for many years with borrowers, and you mentioned 15, 17 years in the business. So you definitely have met buyers at different stages in different markets. Can you compare the difference between the borrower pre-COVID and the borrower after COVID? Have their priorities or worries changed?
I think so. So I think during COVID, not only were we all stuck at home, but we were all stuck consuming so much information. And I think during that time period, we had a situation where there was a lot of buyers and very little homes. So people started paying more attention to things like price, interest rate, monthly payments. And what comes out of that is we have a more educated borrower, which is honestly very nice to work with, because when you come in and deal with a borrower who starts at ground zero, it's nice to educate them, but it's very hard to help them understand like the longevity of this. You know, when you have someone that's been kind of stewing on this for the last 4 or 5 years, consumes so much information, knows where rates are, they come in almost hyper aware of everything we're talking about, and it's kind of easy to take them from that point and then answer all those questions that they have, and it really puts them at ease. Um, I think what people really started paying attention to after COVID was interest rates. Because during COVID, we saw rates come from, they were already coming up. In 2019, we were hitting the fours and the fives, and then come back down to the threes, and everybody was like, it's going to be okay. And then, COVID, so as we start getting away from COVID, rates are in the sixes and sevens, and the alarms are going off. People are like, well, I don't want to buy houses. So it was like a pretty dramatic shift. I want to say we went from 3% rates to everybody selling their homes and buying new ones to rates in the sevens, where the market kind of took a break. And I think we're seeing that kind of cooling off now. But I think people really became very educated and very hyper aware of making sure that they understood what they were getting themselves into.
Yeah, I think definitely I am on the same boat with that. I get buyers coming to me and asking me, "Hey, I saw this on Instagram, on TikTok, on
Yeah.
Facebook. I heard I can do this. Can somebody help me with this program?" And it's great that all this information is available, but I think it's also a little detrimental because it overwhelms certain people. Um, but at the same time, it's great to just have this knowledge because, like you said, we can sit down with our buyers, borrowers, and tell them, yes, this applies to you. We can definitely go that route, or that is not actually available in the El Paso market, or that's not what we can do here. So definitely being able to sort out all this information that we absorb is going to be something that your lender or your realtor can help you do as a borrower. Let's talk about refinancing. Refinancing is something that we hear about, but does it actually make sense for a homeowner? And also, what kind of fees is a homeowner going to be looking at paying when it comes down to refinancing?
Okay, so I'll answer the first half. Does refinancing make sense? Depends on what you're trying to do. I talk about goals a lot because, again, when I meet with my consumers, the first thing I want to start with is, what is the goal of the refinance? Are you trying to pay this loan off sooner? Are you trying to reduce the rate? Are you trying to reduce your payment? Are you trying to get cash out? In every scenario, every goal is going to be completely different. If somebody comes in and says, "Well, I want to save money," for me, that's like perfect. Let's take your 30-year mortgage, turn it into a 15-year, get you a much lower interest rate, and your payment's going to go up. But look at the hundreds of thousands of dollars you're going to save over the next 15 years. And then they go, no, 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 no. I want to save money on a monthly basis. And I'm like, cool. So you want to reduce your payment. A lot of the times, unfortunately, this is the most common scenario. It's always like in the 5 or 7 year mark where buyers will call me back and go, hey, is it time to refinance? And I'll be like, well, maybe there's something we could do. Maybe rates are adjusted. Maybe we can do this or that. The most common one is, I like to take my FHA borrower, turn them into a conventional borrower, get rid of the mortgage insurance. That's always an easy path. Where we kind of disconnect is, I'll be like, cool, you've had this loan for 5 or 7 years. Now let's refinance you into a 20-year mortgage. And they'll look at me and go, the payment's the same. And I'm like, good. That means you're not going to pay an extra 10 years of interest. But they go, well, what can I do to make it lower? And I'm like, well, you can refinance it for 30, but now you'll finish paying this thing off in 35, 37 years. That's not the goal. I always tell my buyers, if you're going to refinance, I'm going to help you find a lower payment, yes, but it might not be lower to your standards. Like we're going to help you save money in the long term. And to answer the second part of the question, fees associated with refinances, it's a brand new loan. We verify credit, we look at your income, we order appraisals in most cases, and the fees are pretty standard, 2 to 3%, because you have to build an escrow account again. There's a title company involved, there's an appraiser involved, insurance, and all that. So it's a brand new loan, typically starting from zero, unless you do like a streamlined refinance. Those tend to be a little bit less expensive, but to really get an impact, a full qualifying refinance costs are about the same.
Let me go a little bit deeper into this question because I do have a lot of buyers that have purchased recently. And when I say recently, I mean post COVID, 2022, 2023, 2024. And they reach out to me and they tell me, Marisol, should I refinance? I want a lower rate. And my answer to them, first I ask, can you remind me the rate that you got?
Yeah.
And it's pretty much the same rate that we have right now.
Yeah.
I usually tell them I have heard by a loan officer from a loan officer that I work a lot with that you at least want rates to drop 1% at least.
Yeah.
Is that safe to say, or would you recommend a bigger drop, 1.5%, 2%?
Yeah, so I mean, I think as loan officers, we all kind of have our thresholds in our rules, I guess. But my rule has always been, if you're gonna refinance, let's at least save you 1% on the rate, or cut that rate, or cut that term lower. And that usually kills two birds with one stone. But yeah, I mean, if you're gonna refinance from a 30-year mortgage at a 7% to a 15-year mortgage on a 6%, you save that 1 point, but your payment's gonna skyrocket. Is it going to save the money? Absolutely. But if someone calls and says, I just want to save, a couple bucks a month, then we'll put you again on a 30-year mortgage, and maybe from a 7, we get you to 6.5, and you'll save $20 to $30 a month. What people don't talk about doing refinances is most refinances, the expectation is not to come in with any money, but you can always choose to buy down that rate. Maybe you didn't have the liquidity to buy down the rate when you first purchased a home, but a couple years into it, maybe now you could afford to purchase, really buy down that rate, and then kind of find a happy rate for the next 20 or 30 years. But yeah, I mean, I always go back to, what's the goal? Like, are we going to save money? Cool. On the long term, or just on a monthly basis so you could afford more water burger at the end of the week? Like, different goals.
I may be a little bit more curious about our market. Do you see very many borrowers willing to do a 20 or 15-year loan, or do the majority ask for a 30-year loan?
Unfortunately, most people still lean on the 30-year loan. And where I meet them halfway, we talked about amortization schedules. Where I meet my buyers halfway is, I'll print out an amortization schedule and I'll explain it ad nauseum. And I'll show them, if you're not going to finance it for 15, if you're not going to finance it for 30, or 15 or 20, finance it for 30, but don't give your minimum payment. If your minimum payment's $1,800, let's at least do 2,000, let's do 2,200. And then I show them the long-term effects of those additional payments and how much money they'll save. And most people will always walk out of my office and go, yeah, 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 we'll do it. We'll do it. Will they? I hope so, because I think even the most savvy of buyers look at the difference between a 15-year and a 30-year loan and think 15 years is a long time to commit for a much higher payment.
Mm-hmm.
And I understand that. That's completely valid. But I always ask my buyers, do you have the discipline to make that additional payment if you finance it for 30 and just say, I'll pay it off in 15 by making additional payments? And most people think about it and go, I think so. And I'm like, if you're not sure, then let's kind of force you and put you on the 15. And 9 times out of 10, they'll still lean on the 30 or 25, and then I'll just make the payments. And I'm like, I hope you do.
They don't want to have that pressure. They don't want to have that risk, which is okay, right? Because again, like we said, I know some of the loans are not going to have prepayment penalties.
Yeah, yeah, yeah.
So So I guess I can't go there.
No, you can't. So, I mean, most of the loans that I do, and most of the loans that are out there do not have prepayment penalties. Where you run into prepayment penalties are a lot of these non QM products that are becoming super popular. Your bank statement loans, DSCRs, your 1090. So, all those loans, pricing actually gets a little bit better if you add like a 1 year, 3 year prepayment penalty. But I mean, let's be realistic. Who's if you could afford to pay it off in 3 years, I think you could afford the little prepayment penalty that's on there. And these prepayment penalties are honestly not that bad. Like the costs aren't horribly bad.
Worth it. They're worth it.
If you're gonna pay off your mortgage loan and save hundreds of $1,000s in interest, I think you could afford a little bit of a
Yeah.
little fee there.
Yeah. No, I agree. Okay, do you have any last words for our listeners?
No, I think we touched a little bit about how much information is out there via social media. And I mean, here we are just adding to the masses, but I think not everything you see online might apply to you. You hired a loan officer, you hired a real estate agent. These are your trusted partners. They should be your main source of information. If you're, trying to get information from Instagram, TikTok, Facebook and think that it applies to you, it's like drinking water from a waterfall. Like go to the people that you hired, have them curate the information that may particularly apply to you. Be curious, yes. Ask questions, yes. But your main sources of information should be the trusted partners that you hired from the beginning.
Thank you for sharing that. That's it for today's episode. I hope this helped cut through the noise around interest rates, down payments, and refinancing. Buying a home is about asking the right questions, not just qualifying. If you found this helpful, like and subscribe so you don't miss what's next. Until next time.